All right, so it's almost 6:05. So, hey
Okay.
everyone, welcome to SARE webinar. This week we're going to talk about 1031 exchanges. And this is something that it's pretty important to learn because a big part of you growing your passive profile and your net worth is not just about, making money off of buying and selling real estate. You guys don't understand how many fees are involved and all the taxes that come in. And ultimately, you might not actually be left with too much. And so the reason why we're having this is because I'm about to do a 1031 exchange very soon. And every time I do something, I like to drag you guys along. This wouldn't be my first time, but when I did it a couple years ago, that was before I met Weiming. And I can just tell you, I did a lot of things incorrectly. I could have done it better. And so it's been a couple of years since I did it, and I remember how stressful it was to learn as I go and picking out properties and all these strategies that were involved. And so I was like, okay, before I do anything, let's talk to my CPA. And my CPA was like, you got to do 1031. All right. First person I hit up is my homie Weiming, who's done probably the 1031s for a lot of our friends in the Bay Area and amongst there. He even did it for Nelson's mom. So we are all homies, and he'll take good care of us. So without further ado, I'm going to introduce you guys to Weiming, and hopefully he can save you guys a lot of money and headaches moving forward.
All
Take it.
right. Thank you very much. Hi, everybody. My name's Weiming, and I'm one of the principals of Excel 1031. We are a 1031 exchange company. So that means the only thing we do is 1031 exchanges. Um, Quickly go over the disclaimer slide. I know Annie's gonna laugh. I'm not gonna read all of it, but I just want to summarize it. I'm not a CPA, not a financial advisor, not a legal advisor. So all the information that I'm gonna give you here today, they are going to be more general information about 1031 exchanges. And if you have any specific questions, I can go into more specific examples as well. However, the numbers I use are going to be more general, right? I don't know your financial situation, and I don't need to know, but I'll show you how you can get the certain numbers for your particular situation as well. Now, here's the 1031 exchange code. I get occasionally people asking, say, "Hey, what does the code actually say?" It says, "No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment." I really don't like saying that. That's the equivalent of me like reading off a disclaimer slide to you, right? So what is a 1031 exchange? Let me just summarize it. A 1031 exchange is a tax deferral strategy, and the use of it is if you have a property you've been using for business, investment, or trade use, and for most people that's renting out that property. If you sell that, this tax strategy can potentially help you to defer 100% of your capital gains taxes. As long as you're going to buy another property that you're going to use for business, investment, or trade use, and you meet all the exchange criteria, the requirements in between. Now, I also get a lot of people saying, what's the end goal? What's the end game for a 1031 exchange? Well, this is, maybe a little subjective, but for a lot of my clients, it's to build wealth for the next generation. So a 1031 exchange does allow you to defer, again, up to 100% of your capital gains taxes, and you can defer that indefinitely. As long as you are either keeping that property and never selling it, or number two, you are selling it but keep on doing 1031 exchanges. It's the only tax strategy that allows you to basically push off paying your taxes indefinitely. It doesn't mean that you'll never end up paying it. There are a couple of scenarios that can occur when you're doing exchange. Number one is eventually down the road, you sell that property, you don't do another exchange, you end up paying your taxes. So, what that typically looks like is if Annie owes Uncle Sam 100 grand today from doing a 1031 exchange, that number is never going to change. She's not going to have to pay interest on that $100,000. She's not going to be able to deduct from that $100,000. It basically follows her through the property she exchanges. So it's essentially saying to Uncle Sam, I'll pay you at a later time, but again, in the future, that amount never changes. So the idea is I'm going to use that money to buy myself more real estate, to buy myself better real estate that's going to give me an income or produce an income that I am looking for. Because if I owe Uncle Sam 100 grand today and I can pay him that same 100 grand 50 years from now, why not? Right. In the meantime, I get to use that money to build my portfolio. And the other thing about the 1031 exchange is in all these years, I can keep on deferring throughout my lifetime. But when I kick the bucket, when I pass away, all these deferred taxes I have accumulated, it passes away with me. So my spouse, if my spouse inherits it from me, or my heirs, whoever inherits it from me, they don't have to pay any of the deferred taxes I have accumulated in my lifetime. So it could be 50 grand from this exchange today, another 50 grand 2 years from now, or however many years. You could accumulate hundreds of thousands, if not millions of taxes that you are going to defer. And if your kids don't ever have to pay it, that's great. You just pass on a lot of wealth to that future generation. Yes, there is inheritance tax, there is estate tax, and there's certain limit for that. But in terms of 1031 exchange, all deferred taxes go away when you pass away. Now that was a quite a lot going into it, but let's kind of dive into 1031 exchanges. One of the things I get asked a lot is, Weiming, are there any changes to a 1031? At the moment, no. There's been talks about potentially limiting how much a person can defer per year. That has been talked about at $500,000 per year or $1 million per year, or even $1 million per couple. Now, if we're selling in California, that's probably or very likely that's going to be reached that number per year. If we're selling in states like, I don't know, Florida, where it's lower entry for price points, they may not feel that as much. All right. Is that going to go through? Who knows? It happens a lot in presidential election cycles. They always talk about, hey, let's do this, let's make changes, let's make changes to tax law, things like that. Um, so we don't know, but currently no changes. Extensions. Are there any extensions to 1031 exchanges? The short answer is no. There are no extensions. Everything is set in stone. The only exceptions are natural disasters. When there's a natural disasters that impact a large number of investors or taxpayers, the IRS typically steps in and issues an extension. Um, if you remember, if you're in California in 2023, we experienced a lot of floods earlier in the year, and as a result, the IRS extended a lot of deadlines to October 15th. And then even when it was coming up on that day, they extended one more time to sometime in November. So it does happen where there are extensions, but only in cases of like natural disaster that affects a lot of people. So so the answer is no. You cannot go and appeal to the IRS and say, "Hey, kind of forgot," or had a big party because it was my birthday and I forgot to you know, do my exchange or something, then unfortunately that doesn't work. Um, Now let's sort of dive into reasons why a lot of clients do 1031 exchange. And as I mentioned, it's a great way for an investor to defer their capital gains taxes. But the other reason is allows you to diversify your portfolio, especially with a lot of members in SEER. I understand the goal is to grow your portfolio, right? And this is one of those strategies where you can maximize what the tax code can provide you. So the 1031 exchange, a lot of people think if I sell a property, I have to buy another one. That's actually not the case. You can buy multiple properties if you want to. That's not a problem. You can buy a two, three, four, whatever you want to buy. And you can also do that vice versa. You can sell multiple properties and buy one larger one. If you want to get into commercial, absolutely. You can sell a lot of your smaller residential properties too and buy a commercial property. And one of the big reasons for that is the cash flow, right? I get a lot of clients who are, especially when they're starting, they want that cash flow. Aside from just the cash flow, you can also do it for appreciation purposes. So, um, appreciation purposes, if you want to sell in an area that um, you're not having as much success in that market, 1031 exchange it. Get into a market that you believe it's going to benefit your portfolio more. That's one of the great uses for that. And you just have to buy a like kind property. I mentioned earlier on my slides the 1031 exchange code. It makes mention of a like kind. That simply means if you sell investment real estate in the United States, you just have to buy investment real estate in the United States. And it can be anywhere in the United States, any type of real estate as well. So if you sell residential, as an example, you can buy residential, you can buy commercial, buy land, multifamily, whatever real estate that you think that you would want to get into, you can do that. I know Annie has real estate in Texas, but maybe down the road she'd be like, yeah, I'm gonna be a big baller. I'm gonna go into New York or something. Maybe buy myself a commercial property in New York. Yeah, go ahead. If you want to get into that market, you can absolutely do that. Um, One of the last reason, not well, not the final, but one of the other reasons is depreciation. If you are a investor, you'll know that if you are using the property for investment purposes, you can depreciate that property. And I'm sure Annie is becoming very familiar with that term, right? Depreciation. So the short definition of that is sort of um, a write off against your income. A property, a residential property, you can depreciate for 27 and a half years. A commercial property, you can depreciate for 39 years. So you're taking a little bit of depreciation every year you own that property. But what happens when you're almost fully depreciated? So you get a lot of CPAs will tell your client, bought your property for two, $300,000. It's worth $1 million now. Not only have you almost fully depreciated, but if you sell that property, you can now leverage it and buy multiple properties if you want to. And if you buy additional value to that, meaning if I sold it for 1 million and I bought it a new property for 1.5 million, because I'm leveraging, right? I'm borrowing more money to get more real estate, bigger real estate, more expensive real estate. That additional value in my example, the $500,000, that's depreciable now. You have more to depreciate, you have more to sort of write off against your income. So that's one way to really utilize a 1031 exchange. Now let's talk about taxes. I know that's a very popular topic in SEER. It's taxes. All right. If you don't have a CPA, find yourself a CPA like Tony. I don't know if he's in the chat, but that's one of the things that I will recommend to everybody I talk to. Talk to your CPA. Find out how much taxes you owe in a 1031 exchange, or if you didn't do a 1031 exchange. And the reason for that is a lot of clients of mine, they get confused, or they will try and do their own research. Yes, some of them do find out all the information they need to find, but often they'll find pieces of the information. A great example of that is if you look on my screen, I talk about capital gains taxes. That's a term that's thrown around quite a bit, right? You hear people say, "Oh yeah, I sell property, now I have capital gains taxes to pay." But when they look that up on Google, oftentimes they will find that they'll find the federal taxes, which is 15 or 20%. So when they look at that and they say, "Hey, Weiming, I'm making 100 grand from the sale of this property, 15%, 20%. It's not too bad." But when I tell my clients, it's probably closer to between 30 to 33%, that's when they really, really consider a 1031 exchange. Now, in terms of the capital gains taxes, it's actually comprised of four different things. We have depreciation recapture at 25%, federal taxes at 15 or 20, net investment income tax at 3.8, and we also have state taxes anywhere from 0 in certain states all the way, actually, I should probably update that because that's 14.4 in California now, up to. Yeah, so if you make $1 million or more, congrats to you though. But you are at the top of every tax bracket. So that's why I tell my clients, because a lot of my clients are from California, um, your tax probably going to be between 30 to 33%. So Uncle Sam's taking a third of everything all the profit that you're making from your sale. Now, if you want to sort of play around with the calculator and figure out how much taxes you could potentially owe, we actually have a tax calculator on our website, and it looks like this. We talk about the basis. The basis is how much you bought your property for, plus improvements and minus depreciation. This is useful in order to find out how much profit you're getting from the sale of your property. So I have all these calculators that you can play around with, and at the end of the day, you'll be able to figure out roughly how much taxes that you might owe if you were to sell whatever property you're looking to sell. So play around with the calculator. Now, the other thing I want to provide everybody is on our website, we do have a checklist. I know that some clients, they want to be on top of it. I totally get it. This is what you need. Every step of this transaction is spelled out on this checklist, starting from consulting a CPA or legal advisor or tax advisor. That's optional. If you want to consult one, or if you have one, go for it. I definitely recommend consulting one. And once you figure out whether or not an exchange is appropriate for you, whether or not you need it, you can always contact me. I'll walk you through the process as well. I'll do some of the calculations so we can kind of see, is this something that you would want to do, right? What are your options in the 1031? So it goes all the way to what it looks like after you complete it, and at the end of the day, we will walk you through the process and provide you with any information you need for any tax reporting as well. Now, let's dive into 1031 exchanges. Actually, let me turn on the lights for a second. Sorry, I'm doing this in the dark. Lights. um, So, types of 1031 exchanges. They used to be only one type, actually. 1031 exchanges have been around for over 100 years now. Yeah, it's old. All right. It used to be that it was originally sort of structured for farmers. Farmers used to, grow their crops, whatever they're growing. Once the soil, the land is no longer as nutritious for whatever crops they're growing, they can exchange it into other lands. And they used to only have one type of exchange available. It's called a simultaneous exchange. This is when you close on the property you're selling and the one you're buying on the same day. You can do it, but you don't have to. It's not your only choice anymore. Don't stress yourself out. Don't stress your realtors out. Don't stress your escrow officers out and everybody involved, right? Because you're trying to make this work on the same day. If you close after 24 hours or anytime after within the 180 days that a 1031 exchange allows you, we have what's called a delayed exchange, often referred to as a regular 1031 exchange. This is when you sell your property, and from the close of escrow, you have 45 days to pick replacement properties and a total of 180 days to close on any of the properties you have picked. So 180 days, it's about 6 months, depending on which of the months we're talking about. Again, don't stress yourself out. You do have the full time well, you have 45 days to pick, full time to try and close on any of them. You do not have to do it on the same day anymore. And I'm not trying to freak Annie out because she's giving me this like scared reaction. um, so that's called a regular exchange, what most people call regular exchange. Official name, delayed exchange. The third type of exchange is called the reverse exchange. This is when you buy the new property first, and from the close of escrow, you do have 45 days to tell me or notify the exchange company and put in writing what properties you want to sell. That should be fairly easy unless you have a really, really big portfolio. But you do have the 180 days to sell your property. Again, buy first, basically have the 180 days to sell and close your property. It sounds a lot easier, but the biggest obstacle is the money. We heard that before, the money, right? In a reverse exchange, you haven't sold your property yet, so you don't have the money from their sale. Where do you get the money to buy the new property? That's one of the biggest obstacles with the reverse exchange. And I can talk about that later on if we get people asking, we have more time as well. The fourth type of exchange I want to talk about quickly is called the construction or improvement 1031 exchange. In my opinion, and for me personally, it's my favorite one. It's also, in my opinion, the most versatile one. The reason for that is the construction improvement exchange lets me use any of the exchange money in my exchange account or in the exchange to improve the property that I'm buying in the 1031 exchange. So I always use Annie as an example. So she doesn't mind. If she sells a property for $1 million and she has a really good real estate agent that finds her a very good value property, let's say for $850,000, well, she hasn't met all her requirements, right? She still has $150,000 left. Well, in that example, she can use the $150,000 in the construction or improvement exchange to fix up or build upon the property she just bought. New roof, new pool, new ADU, whatever improvement, whatever capital improvement she wants to make, she can make those on that property. So that opens up a lot more possibilities for properties that you might be thinking about buying, right? Because in a lot of cases, with my clients too, um, somebody like Annie might be thinking, "Oh, I have to reach that $1 million mark. I have to reach it, and anything below that, that's not going to work." Well, you can. You can look for something less and just build on it if you need to, right? Either that, or she can spend the 150,000 as a down payment on another investment property. She can do that too. Remember, she can buy more than one replacement property. Last but not least, we have the reverse construction exchange. Excuse me. This is when you purchase the replacement property first and start improving on it. And in the meantime, within the 180 days, you can sell your property. So it's a little bit of both the reverse and the construction. Get it purchased first, start on the improvements right away before you even sell. So you can absolutely do that. So what I'm trying to get out of for everybody to get out of this is there's a lot of options in the 1031 exchange. Don't think that just because if you sold a property, you don't think you can buy replacement, that's the only options you have. There are other ways that we can potentially look at this and see if there are other options available for you. Now, ladies and gentlemen, let's talk about the key points to keep in mind for a successful 1031 exchange. We have property qualifications. A lot of times people will ask me, Weiming, how long do I need to rent out a property for in order for it to qualify for an exchange? Now, you are going to hear this directly from me, a 1031 exchange QI. There is no time specified in the Internal Revenue Code. They don't require any timeline outside of a vacation rental. So if we're talking vacation rental, yes, there are required times, that amount of time you need to rent it out. But for everything else, there isn't one. So you'll hear that from a lot of people, whether or not it's your CPA or your fellow investors. You need to rent it out for at least a year. You need to rent it out for at least 2 years. Those are typically the two that I hear the most. So, what's the correct answer? Technically, there isn't one. They both work, and the reason for that is it's based on a lot of CPA's recommendations, right? They recommend that a lot of my clients have at least a year's worth of rental history on the property before doing exchange, and the ones that are more conservative, they're not risk takers, right? They don't want any risk on their exchange at all. CPAs will recommend 2 years or longer, double that time. Right. And one of the reasons for the 1 year mark is a lot of CPAs know the year difference, the year mark, it's what separates long-term capital gains and short-term capital gains, right? So can you do an exchange in under a year? Yeah, if you want to, you can do it. Again, the only requirement is using it for business, investment, or trade use. Those are the requirements to qualify the property. So if you've been renting it for, let's say, 364 days, can you do it? Sure, you can. Uh, but your CPA is probably going to say, rent it out for one more day. Now, tax deferral. How do I defer all my taxes? Two things you need to do. Number one, reinvest all the cash. And number two, purchase equal or greater to your net sales price. Let me give you some examples. Uh, where's where's my examples? Here we go. So in this example, if I sell my property for $1 million and well, I still have to pay my closing costs, right? My real estate agent's not doing it for free. Escrow's not doing it for free. I still got to pay everybody. So in this case, let's say that's $100,000. I know it's a little high, um, but it's just easier that way. Just the numbers. I get a net sales price of $900,000. I need to buy a property for $900,000 or more to defer all my taxes. Pretty simple. Now, what happens if I have debt? Well, remember the two requirements are, why can I not go backwards on this? Okay. The requirements are spend all the cash and purchase equal or greater to the net sales price. So I think I have that in my previous slide right there. Reinvest all the cash, purchase equal or greater to the net sales price, and replace the debt. In this case, my cash is 400, but I need to buy for $900,000 or more. The government doesn't care how big of a loan you have, right? They're not gonna say, oh, just because you have a loan that you can reinvest less. No, you need to reinvest your net sales price. And this is where a lot of clients get confused. Because in this example, let's say I'm the lender and I'm such a good friend and lender that I loan Annie $900,000 on this property, right? When she sells this property and she pays me back, she has no cash, right? She doesn't have cash from this sale. That doesn't mean that she doesn't need to do an exchange. Just because there's no physical cash she's getting, she's still realizing profits on her tax returns. So that's the reason why. Um, they don't care what your loan is. So you need to reinvest the cash proceeds and purchase equal or greater to $900,000. Now, if you bought for less than $900,000, you will have $100,000 left in this case. Let's say Annie buys it for $800,000. She has $100,000 left. What are Annie's options? Well, option number one, don't spend it. She can keep it. She'll get that money back at the end of her exchange and she can go on vacation with it, whatever she wants, right? But she is paying taxes on the $100,000. Spend it on more real estate. Annie can use that as a down payment or to even buy a property if she can find something for $100,000. That's her second option. Or use it in an improvement or construction exchange. Use the $100,000 to make that $800,000 property better. New roof, new pool, new ADU, whatever you need, whatever capital improvements you need, you can use that in an improvement or construction exchange. Now, one of the questions I typically get from this is, and I'm kind of sensing that from a lot of looks I'm getting is, well, Wei Ming, why can't I just use my profits, my capital gains in this case, right? So if you're saying that the net sales price is 900,000, and let's say Annie bought this property for 400, her profit is sorry, she bought it for 500, her profit is $400,000. So why am I telling Annie she needs to buy for $900,000? Think of it like this. Your When you buy a replacement property in a 1031 exchange, the first money you spend is your basis or your original money. Only after you spent what's on top can you start spending your profits. So remember in my previous example, if Annie only spent $800,000, what is she spending? She is spending 500 of her original money and only $300,000 of her profit. It's basis first, gains last. So that's how the government looks at it. So again, when Annie buys that property for 800,000, what kind of money is left over? That 100,000. What's left over is the $100,000 of profit. That's why Annie is going to get taxed on it if she doesn't spend it. Any questions so far? I know this part can be a little confusing. We're good so far? Oh, feel free to unmute yourself and let me know. Now, I understand the part where we have to buy a replacement property. But this is where the client says, wait, Ming, let me get some of my money back, right? I put money into this property. It was my investment. Let me get some of that back. Well, Uncle Sam is going to say, uh-uh, we don't look at it that way. Whatever money you take from the sale of your property, we're going to consider it profit first before basis. So that means when Annie says, Wei Ming, excuse me, when Annie says, Wei Ming, can I take 100 grand and just invest the rest? Can I take some of my original money back? Answer is no. You can take some of the money, but the government's going to consider it profit first. Sorry if you hear a little bit of snoring. My dog's uh, bulldog, little bulldog, so she snores pretty loud. Um, Now the time requirement for a 1031 exchange, the third guideline. From the close of escrow, you have 45 days to identify potential properties to buy. We will give you a form. You fill out that form with the address of the properties you're looking to buy. We'll send this electronically. I know I did this. I don't know why I did this. It's not a physical. We can send you a physical form, but most people sign it electronically via PDF and everything. But the most important thing is you have to submit that list to me or to the exchange company by midnight of day 45. That's your homework, if you will. It's due on day 45. Now, a lot of people say, hey, Wei Ming, what can I do with this list? Change it, whatever you want to do with this list. You can make whatever changes you want to it before day 45. You don't even need to let me know. I don't need to know. Don't keep submitting, forms to me like on day 1, day 2, day 3 and then changing your mind. That's a lot of work. I'm going to save you the trouble. Just submit one list by day 45. That's it, right? And the reason for that, the reason I'm telling you all this is yes, Annie can submit a list to me, let's say on day 7. She changed her mind on day 8. She has to email me and tell me, please revoke the previous letter. Here's the new one. Then she changes her mind on day 10, sends me another email having to say to revoke it. That's a lot of work. Just don't tell me at that point, right? Just don't tell me, don't submit anything yet. And once you have that list that you absolutely want by day 45, send it to me one time. That's it. Right. I don't want anything to kind of get lost in translation. Not translation, but lost in the email and all that. And sometimes it can happen, right? And none of us want that. We don't want to miss anything. And the great thing is about not telling us beforehand. If you happen to finish your exchange before day 45, let's say Annie found something really really good by day 10, she buys it, she's done with her exchange. No need for day 45 identification. She don't even need to submit it to me. She's done. Her exchange is done. That's it. So don't submit to me by until day 45. And of course, the 180 days. She does have the rest of the 180 days to complete her 1031 exchange. Now, Annie asks is, what are some of the rules for identification? There's three actually. Sometimes a lot of exchange company only talk about two. There is three. The third one is hard to use. A lot of people don't like talking about it, but I'm gonna talk about it anyways. The first rule is called the three property rule. It allows you to identify up to three properties of any value. All right. So if you're looking to buy no more than three properties, this is the rule you're probably using. Um, and typically, if you're selling in California and also buying in places like California, this is the rule I typically see clients use. You sell for $1 million, you might buy for $1 million or more. The second rule is called the 200% rule. It allows the client to identify as many properties as you want, but uh, sorry, combine all these properties cannot exceed an aggregate value of 200%. That means all these properties you pick combined together cannot equal to more than 2 times what you sold your property for. So if Annie sells a property for $1 million in California and she wants to build that portfolio of hers, let's say in Texas, 2 times that amount is $2 million. She can probably pick up what, four, maybe five properties totaling about $2 million. So if that's the route she wants to take, absolutely go for it. So this is one of the rules where it's known for more bang for your buck, if you will. Last but not least is the 95% rule. Extremely hard to use. I would hope people aren't using it unless they're doing a portfolio transaction. This allows you to identify as many properties as you would like, no limit to the value of any of these properties. Only catch is you have to buy 95% or more of the total value, or your whole exchange fails. Right? There's no like, oh, I didn't spend $1,000. I'm gonna pay taxes on the thousand. No, if you use this rule, it's you better buy 95% or more, or your whole exchange is kaput. That's it. All right. Um, so it takes the best of both from the three property rule and the 200% rule, but that 95% really catches people. And I've done over 2,000 exchanges by now. Um, I've only seen it used like 4 times. That's it. Yeah, just four. Now, ladies and gentlemen, let's talk about some of the pros and cons about 1031 exchanges. And I don't have a problem about talking about the bad stuff about it either. Right? So let's use an example. In this example, oh, I just slapped my mouse down. That went really far. Um, in my example, I'm selling a property for $1 million, and I have a basis of $425,000. So in this example, my profit is 575. And remember, I said on average, a client's taxes could be between 30 to 33%, and I'm gonna use that 33% in this case. If I do a 1031 exchange and meet all the requirements, I'm not paying any taxes yet. I'm deferring all my taxes. I do, however, still need to pay my real estate agent. Otherwise, he's going to get mad at me. All right. I need to pay escrow. I need to pay the people working on the deal. They don't work for free. So at the end of the day, I have $900,000. What are the pros and cons? The pros is I have $900,000 working for me. The pro is I have $900,000 I can spend in real estate, and that $900,000 is working for me in real estate. And what are some of the bad things? Well, I can only buy real estate. That's it. I can't start a business. I can't buy a boat. I can't go on vacation with that money and be tax free. Right? I have to buy real estate. So that's the pros and cons about that. It's limited to real estate. Now, let's talk about somebody who's not doing exchange. What if I don't do an exchange? Well, 33% of my profit is about $197,000. Yeah, that's huge. And if I don't do an exchange, not only am I paying my realtors, my escrow agents, and whatnot, I'm paying Uncle Sam. So at the end of the day, I'm looking at $700,000. Now, anybody can see if I'm going to be buying real estate, I want to be that person with the $900,000 rather than the guy with 700,000. The $900,000 guy is going to win over the $700,000 guy any day of the week, right? No seller is going to say, "Yeah, let me take a $200,000 haircut." Right? So, if you're going to be buying real estate anyways, look into a 1031 exchange. See if that's going to help you. Now, if you're not going to be buying real estate, let's say you want to put it in stocks, yeah, go right ahead. You can put it in stocks. You can buy stocks with this money, but the question is, how long is it going to take you to recoup that $200,000 difference? And the difference with stocks and real estate is, in order for you to realize the profit on your stocks, you're going to have to sell it. All right. Whereas in real estate, not only is my property appreciating in value, but I can always refinance and pull out cash if I need to. The cash I pull out from refinances, they're not taxable. Yes, you do pay the lender whatever fee it is to borrow that money, but there's no capital gains taxes on money that you refinance or borrow. Now, ladies and gentlemen, I do want to talk about one of the things that occurs pretty often. This is what we call split treatment. And this is something that happens when a client is house hacking, which is very, very popular in SEER. I see a lot of people doing it. I see a lot of people talking about it. And how do I benefit from this? Well, in this example, let's say the property is valued at $1 million. Bought it for 400, valued at $1 million. Your profit is $600,000. In a normal transaction, if it is purely your primary residence, if you're married, you can take up to $500,000 tax free. 250 if you're single. So maybe something you want to think about getting married. Who knows? um, so in this case, $500,000 doesn't erase the whole $600,000 gain, right? If you can take up to $500,000, you still have $100,000 of gain left over. Now, in this example, let's say it's somebody house hacking, right? House hacking, they are living in part of the property, they're renting it out. What is this going to look like? Well, because it's 50% primary, 50% rental, I'm splitting all these numbers in half. My basis, I bought my property, my primary home, for $200,000, is valued at $500,000, half of the million. So in this case, my primary is only has $300,000 of gain. If I'm married, I can take the whole 300,000. I'm good. I don't pay any taxes on that. The other 50% of the house that's rental, it can be 1031 exchanged. Now, this method of house hacking, this method of utilizing both, works the other way when you're buying a property. Let's say, for example, you're doing a 1031 exchange for $500,000. If I'm looking at $1 million home, I can still do a 1031 exchange for the $1 million home, but I need to rent out half the property because $500,000 of that money came from a 1031 exchange. So what about the other half? The other half million? I can do whatever I want with it. I can live in it if I want to. I can, or I can rent out the whole property. Whatever it is, if I am doing an exchange for 500,000 and I buy $1 million, I'm renting out 50%. If I buy for 2 million, I'm renting out for 25%. Now, it doesn't have to be completely rental. It can be you convert space for office use. That could be a 10% right there. You have kids at home that's 18 and up. Yeah, they can pay you rent, maybe another 15%. You can play around with the numbers a little bit and see what works best for you before you make that decision. Okay, ladies and gentlemen, last but not least, something that Tony is very familiar with. This is a form he will see quite often for clients doing 1031 exchanges. Sorry, that's a little cold wiping my nose. 1031 exchanges, when you complete it, you will be filing this form along with your tax returns. This is the form 8824. You can Google that and it will take you to the government's website, first page. It basically asks you about your 1031 exchange, where you sold, where you bought, how much taxes you're deferring. You're giving a summary to Uncle Sam, basically. This is what they look at. And that's how they know that either you owe them tax money or you don't, and you're deferring all your taxes. For some of my seer friends who are selling in California and buying out of state, Annie, this is a form that you may have seen. This form is often referred to as the California clawback. It means Annie sold a property in California. When she does a 1031 exchange, California is missing out on some of their tax money. All right. So Annie went and bought properties in Texas. Well, California said, shoot, Annie took that money and went to Texas. I don't know why. Maybe it's because of high tax. Who knows? But Annie now owns real estate in Texas. but the money came from originally in California. California is going to say, well, Annie, every year you own that property outside of the state of California, you need to fill out this form. Every year. They want to know as soon as Annie sells that property, they're going to go, Annie, are you doing another exchange? If you are, it's cool. Just keep on filing this form wherever that property ends up. But if you're not doing another exchange, money, please. That's California. This is the California clawback, 3840. So that actually concludes my presentation on 1031 exchanges. I know there are a lot of scenarios that can happen too. So feel free to reach out to me at any time. The QR code in front of you right now on the screen, that has my contact information, but that also links you to the calculator and a link to start an exchange if you would like as well. Now, if anybody has any questions, feel free to unmute yourself or kind of talk. I don't know how long Annie's going to let me talk for, but I've
Oh,
been talking a lot.
I'm gonna let you talk a lot because like I need the knowledge for myself. I'm doing the 1031. So this webinar is gonna go on as long as you're alive and you're willing to listen to me talk. And actually, there's a
Okay.
lot of questions in there too. If
Okay. So
it scared me about the California thing. Like I literally
oh
just wrote a note to double check my taxes and bug the shit out of Tony if I don't see it.
yeah, it's you know that clawback, the 3840,
Yeah.
before 2015, it was kind of a sort of honor system. You're supposed to notify California if you sold it, but I guess some people ruin it for everybody. I'm not gonna say the reason why. You can probably guess. They now go like, yeah, not enough people are doing that, so it's now a mandatory thing.
Shit. Because that's exactly what I did, but mine was like in 2020. And I just signed things. I don't remember what I did.
That's what CPAs are for. So the first question is, does a 1031 exchange knock out state taxes too, or is it only federal? Four different taxes: depreciation recapture, net investment income tax, state, and federal. So four things.
Hey, for once they're nice to Californians. It's 1031.
Uh,
Because it doesn't
mm,
like for some stuff, like if you're a real estate professional, like you can knock out the federal, but then like they don't have it for California. So I was like, hey, it's okay this time.
The next question is, what's the timing for the construction? You have the remainder of the 180 days. So the construction and improvement exchange, the name might sound a little misleading because some people think, oh yeah, I can build a whole house during that time. Yeah, you probably can, depending on how fast you can build it, but typically it's for improvements. Have I seen people build a house in like 4 or 5 months? Yeah, I've seen it in smaller houses. Yeah, absolutely. But a lot of times people take time to get permits and all that other stuff, right? So that takes a lot of time. Yes, you can use that money to pay for the permits too in that improvement exchange. So that does count. The other thing to be aware of is it's for completed work only. So I like to use this example because I had an uncle who was trying to do something like that. He was like, "Yeah, I bought all the wood and all the material." Don't count, uncle. You gotta have completed work. Just because you bought the material, it wasn't used for the construction, therefore it didn't count.
Then how about can I buy like a brand new build that's not fully done yet? So pretend, hey, I'm actually going to Vegas in April, and then we're gonna check out new properties. But they're not fully done yet. Can I still buy it?
Yes, you can still buy it. So that's a very good example, and I'm glad you brought that up, Annie, because there are a lot of clients who will buy new builds, right? And here's here's a tip, if you will. You can use your own money as a down payment today to get it started before you even sell your property, so that when your property sells, the money goes into your exchange account, right? And then you can use that money to pay for that property. and at the closing, you get reimbursed back for your deposit. And the reason you want to do that is a lot of builders will tell you, oh yeah, it'll take me 5, 6 months to build. Heavy rain, oh shoot, give me a couple more months. Well, I don't have a couple more months. I'm doing a 1031 exchange, right? So you can use your own money right now just to get that work started before you even sell your property. So if you're thinking about new construction like that, that's a tip that you can use. Um, get started sooner, basically,
And then so Nya actually has a question in here related to that. How far ahead can I prepay that down payment?
as far as you need. Yeah, your 1031 exchange doesn't start until you close escrow on your sale. So you can literally prepay for a property 6 months in advance, and the builder comes back to you and says, "Hey, we're gonna be done the next month. Quickly sell yours. Maybe close on the new construction in a week." You can do that.
Or if you're homies with them, maybe you can go like, "Hey, hold this for longer. I'm not quite done. I need a little bit more time."
Yeah, whenever you need.
Right. The next one is, can I use that money to build a house on land that I already own if it's going to be a rental property?
Uh, that's a um the short answer would typically be no. The long answer is yes. It's quite expensive. Um, it involves a lease back. So how do I without getting into the like the super nitty gritty into it? So the answer is yes, it can be done, but you're probably looking at fees between like 10 to 15 grand at least to get that uh to get that done. Yeah.
Is it a reverse 1031?
No, it's a lease back hold. Essentially, you create a entity that is going to lease the property, and so that allows you to make those improvements in a improvement or construction exchange. Um, so short answer is there's a lot of um and there's an entity that needs to be created involved, a lot of structuring involved as well, but yeah, it can be done, but very, very costly.
And I can 1031 into buying a land, just buying land. That I say, I know you said it has to be for business function, but hey, I'm going to rent it to a farmer. They're going to rent it to me.
You can buy land, absolutely. So land is unique in that even if you don't do anything to it, it's considered investment because you can't depreciate land, right? It's held for future appreciation purposes. But the drawback to that is you can't defer your depreciation recapture tax on the sale of your property because you're only buying land.
Mm, good. So Sue asked, at the beginning, you said that the taxation liabilities die with the owner, but taxation liabilities are able to be garnished on the deceased estate. Is that correct?
That's not to do with the 1031 exchange. That's something else entirely. What I was referring to is if I keep on doing 1031 exchanges in my lifetime, right? I can keep on deferring my capital gains taxes. And when I pass away, that is forgiven. That passes away with me. And that's capital gains taxes. So anything like estate taxes, um, inheritance tax, for example, those are still applicable to the property. So that depends on what those laws are in the future. But as far as 1031 exchange deferred taxes are concerned, all of that is wiped out.
Mm, nice. And then Lucy asked, what happens when you have the depreciation recapture? Is that added to the basis?
Depreciation recapture is deducted from the basis. So I have my calculator here. Uh, so if you want to calculate what your basis is, you put in your original purchase price, and you would subtract, and this subtracts the sorry, that adds the capital improvements but subtracts the depreciation. Yeah, so depreciation lowers your basis, but capital improvements increase it.
Mhm. All right, so this one is from the Facebook group from Solomon. So he says that he had an ADU built a couple years ago, which now his wife and him and his son they moved into. And so instead of living from the main house, he now lives in that ADU. And he's planning to kind of segregate the lot so that the properties are separated. And that way that he can actually sell the properties separately. So the ADU and then plus the house. And so he wants to know, can he do a 1031 exchange with the separated lot? And what happens if he decides to move into the newly purchased property in the future?
Very good question. The to summarize that question, it's basically, hey, I have a house, I have an ADU, I'm going to subdivide it and sell it as two separate properties. So that's the summarized version of that question. You have to be very careful about this because um a lot of people don't know this, but when you subdivide the property, you're essentially getting two new properties, right? Let's say you've been renting out your main house, you've been living in your ADU for forever. You subdivide it, your ownership in those two new properties restarts. So you could have been renting out your main house for 10 years, but as soon as you subdivide, there's no rental history on that because that's a new house now. So what does that mean? You can't 1031 exchange that. And your ADU, you may not be able to take your homeowner's exclusion. So be careful when you do the subdivision. Right. Again, subdivide restarts the ownership as new properties.
And now I have a gajillion more questions just because it's so
Go
much
right
fun.
ahead.
And that's how I test if you actually know your shit. All right, so pretend that I sold one property and I end up buying three.
Mhm.
And 2 years down the road, hey, I want to do another 1031, but I only want to sell maybe just one of those three properties. How do I do this 1031? Do I have to sell all three? And how does like the tax basis stuff work when I do that?
Good question. So, make just a little easy for me. Let's say you sell uh for $900,000. You buy three properties at $300,000 each. The basis is split evenly amongst the three, so are the profit from the gains, right? So when you sell that property, that's how you calculate in that example. Let's say you bought your original property for 300,000, sold for nine. So each of the house would have $100,000 basis and a $300,000 net sales price, right? Or $200,000 gain in this case. So if you were to sell it, depending on how much you sell it for, that's how you start that calculation. So you don't
So
have to sell all your properties.
what that is that did you just divide it by three evenly for the numbers to make sense, or is it because
Yeah,
it's
I,
actually
I
prorated for like if it's 400,000, that's four out of 400 out of 900.
yeah. So it's prorated depending on how much you end up spending on the replacement properties. But I made it just a little easier for me and just said they all divided evenly. Just because we can kind of get into a number, makes it a little harder to visualize, right? But if we have 300, 300, 300, then yeah, if you want to sell one later on, that's fine. And that's also another good use for 1031 exchange because, you know, our goal is to get a really large real estate portfolio at the end, right? To get us that, or that sort of retirement we might be looking for later on. And the exchange allows us to diversify into so many real estate later on that, some people, I do know some people that will buy one large property, and at the end of your life, if something happens, what if you need to sell and you need money? This is the only thing you got, right? But if you look at Annie, like later on down the road, she has 50 properties. She has options. You can sell that smaller property just enough to get the money that you need and pay the little bit of taxes associated with that property, right? You don't have to sell your one and only thing. So think about that too when you're like diversifying. CPAs are not always fans of this because you kind of need to keep track of all the properties you diversify into.
Luckily, Tony is young and smart. He'll figure out it when I buy 50, and he hopefully is not retired by then. So there's this also another question I saw a couple days ago in SARE, and Barb's had asked, "Can I do a 1031 exchange if what I want to buy the replacement property is a subject to deal?"
Yes, you can do that. Again, as long as you meet the exchange requirements, right? So a deal like that. So for everybody listening in who aren't familiar with that, you're essentially taking over the existing loan when you buy that replacement property. And one of the requirements for the 1031 exchange was where is it? Reinvest all the cash and purchase equal or greater, right? So in this case, let's say you came out with um, $400,000 on the sale of your property, and you end up buying a replacement property, and they have existing loan 500,000. That works perfectly. But if they have a existing loan of, let's say, $400,000, you're short money. You just come up with it somehow, borrow more money, or come out of pocket. Yeah. So the short answer is yes. You can take over a loan on the replacement property. That's not a problem.
So speaking of loans, oh, this is one thing that's kind of annoying to me. Okay, so what I remembered at first, what you earlier talked about, is that when you have a 1031, you have to basically buy within the same entity or the same name. So if it was me, Annie Lou, my new home has to be under Annie Lou. If I bought in an LLC, it should be under the LLC, right? So this is a real life situation I'm considering, and I'm having trouble thinking about this because I'm going to be selling an 8 unit that I have soon. So that's a commercial loan, and I bought that. I originally bought it in my name. I put it into an LLC. So I know when I sell it, I have to do an LLC. But the thing is, I want to buy it in a single family home, and I qualify for conventional loans and all of that, but they will only let me close it in my personal name, not my LLC. So am I screwed over? What
No,
am I gonna do?
the good news is no, you're not screwed. You're the single member LLC, correct?
Yes.
So single member LLCs are disregarded for tax purposes. So that means that if you sell under that LLC as a again disregarded for tax purposes, what they see is Annie sold the property. Annie has three options. She buys under her name, her disregarded entity like an LLC, or even her revocable trust. Those are your three options, right? So lenders don't lend to LLC. That's fine. Annie can go ahead, buy the replacement property under her name, get the loan under her name, and the next day put it back into the LLC. I don't know why I've had a middle finger. That's why I didn't. But she puts it back in the LLC the very next day. That's fine.
So then I just use my same LLC again. Oh, okay. I could save some money on that.
Yeah, I think the only you would want to talk to escrow
Okay.
about recording it the next day or however long you want to wait until you put it back into LLC. That's up to you. They might charge you some recording fees though.
Makes sense. Got it. And then going back onto your construction improvement slide.
Mhm.
So you mentioned that so they have to finish the capital improvements by the 180 days. But like how do you when you're buying it and then you're going to be doing construction on it, how do they calculate what your ARV is to make sure that you actually meet that minimum amount
The amount that you need to
replacement?
reinvest. Okay.
Yeah.
So there is the amount of money that we have in the exchange, right? So in my case, uh, you have $1 million, you bought a property for 850. We're still holding on to $150,000 for you. You are the one who will go and look for contractors, whoever you want to hire. Doesn't even matter if they're licensed or not. The only thing we are concerned with is sending the money to pay for the workers, right? That's one way to do it. The other method is you can pay for all of that and we'll reimburse you. And at the end of the 180 days, let's say there's no more money left. All right, Annie spent it all on the improvement. That's it, right? We're not going to go and physically check the property. What we're telling you is it's supposed to be for completed work. Do I know if it's completed? Nope, don't know. Not our thing to check. We don't report it to the IRS or nothing, but we are telling you it's for completed work. Um, and if there are any money left over, let's say there's $5,000 left over at the end of your exchange period. Let's say it's day 181. We're gonna go, Annie, you didn't spend all of it. We are gonna have to send you back this money less 3.33% for the franchise tax board withholding if you sold um, in California. So yeah, that's how we sort of uh, determine whether or not you have spent all that money, if you will. And remember, the other thing is you do have to do this on your tax returns, right? You do have to file that form. The government does ask you where you bought, how much you bought, things like that, how much you spent basically total on your replacement property. This is their cheat sheet, their overview of your exchange. So if you lie, that's tax fraud. So you got to tell them the truth. It's like, hey, I didn't spend all my money, or I spent it all.
So you're saying with the amount that I have left is that you guys will withhold the 3.33 because I'm California, and then you send me the remainder, and then I'm taxable as the on the whatever is whatever I'm just taking out on that boot then.
Yeah. So whatever is
Don't spend that money
remaining
because
of
you're
that.
gonna have to pay taxes on a
Yeah.
third.
Yeah.
Then okay, because I had that situation happen to me before, and I had like leftover money on that, and so are there ways for me to not have to pay taxes on that remaining amount if I can't buy another property? It's already past at 45. Could I have taken that money and then put it into a DST and then have you guys send the money to the DST?
Ah, gotcha. So if that is one of the things that you're thinking about, put a DST as one of your options on your identification list. Because if it's not on your list, it's not something that you can use the exchange money to buy. So that's why a lot of people doing DSTs, they will tell you, hey, uh, just put it as one of the backup options, whether or not it's like number three, number four, number five, whatever it is. Um, Use it as a backup. In the absolute worst case scenario, you go like, oh yeah, hey, I have like 50 grand, 75 grand. Can they take it? Oh, you're gonna have to ask the sponsor, the ones who put it together. But yeah, most likely they'll take that money.
And for the people who don't know what a DST is, can you explain what that is?
Sure. DST stands for Delaware Statutory Trust. It is very similar to a syndication, very similar to a triple net property. Think of it like a little bit of both, a little bit of triple net, a little bit of syndication, in that it was okay by the US Treasury Department in 2004, and it allows you to buy ownership, percentage ownership in a much larger commercial property. So one of the most popular during COVID was one of those Amazon warehouses, right? Those packaging warehouses. So that was a DST. A lot of people got into it because they thought, "Hey, my tenant's basically Amazon. My tenant is Amazon, right? Amazon's not going to walk out on this." So instead of being able to buy the whole warehouse, you could buy like 1%, 2%, half a percent, whatever it is. Just you can dump whatever money you have left over into that.
And then do you know what like the minimum amount usually would be to do something like that? Because I know syndications are like 50 up to 100,000.
Yeah. So with just your cash, it's 25,000. They say from 1031 exchanges, it's $100,000. But exceptions.
And
Yeah,
we know people.
yeah.
Right?
So they don't like announce that or anything, but like if you have some leftover money, yeah, they'll take that.
And you actually also mentioned something good too, because how about if I want to do a 1031 and oh my God, I don't want to be a property owner, I don't want to be a landlord. Can I dump it into a syndication?
Yeah, as long as that syndication allows you ownership of the actual real estate, because a 1031 exchange does require you to own real estate too, right? If you don't want to, manage your property or something, and this happens a lot in the SEER groups because the people talk about it. Buy with a SEER member if you want to, right? Buy with your buddies. You can own real estate together. A 1031 exchange will allow that. Doesn't mean that you only have to be the only owner. If Annie wanted to, she can sell one of her Texas property, let's say for $500,000, and then she goes and buys it with Nelson, on his $20 million property, whatever it is, and it could be like 1%, whatever percentage that comes out to, and Nelson could be 95, 99, whatever it is. All right, as long as they're tenants in common.
Got it. So he brought up this really important is that it has to be tenant in common as an actual owner, meaning I'm also on the deed. And the reason why I'm trying to bring that up is because when a lot of our friends who are investing in syndications, you are considered as a limited partner or an LP. You're not one of the full owners. You get a cut of one of the, whatever amount is coming out. So that's why, like, it was a clear, like, to clarify for people is that you have to be one of the owners. You can't just be one of the limited partners who's investing into the syndication, because then they would fuck up really bad. All right. And then another question for you. So, I'm California. I buy in out of state. I'm buying in Texas and Atlanta. So when I'm working with a QI, do I have to work with someone that's within my state that's selling or what I'm buying, or can I work with anyone in any state?
You can actually work with anyone in any state, whoever you feel comfortable with. One of the things I'd like to tell clients is, if possible, even if you're not using my services, pick one in California. Very strict about exchange companies. We are required to be insured and bonded for at least $1 million. Even some of the states that do require these, they could require only 250,000. Right. Obviously, we're doing a lot more. We're covering 5 million or more. There are companies that will cover 50 million, but um, we'll at least for me, 5 million is going to cover the majority of that, majority of the exchanges. We can always increase the policy if needed, for whatever situation that we might need to handle. But yeah, pick one in California if you need to.
And then is there when I'm researching my QIs, do I need to double check if they have a certain license somewhere, or like, hey, everyone can actually do it just anywhere in all 50 states?
There isn't a license to that is required in every state. The only one that is required is Idaho. If you are selling in Idaho, you have to be licensed to do the exchange out of Idaho. Yeah, very specific. It's a state requirement. Um, if you're selling in Idaho. We can help clients get into Idaho, but because we're not licensed to do so, we cannot help them exchange out of Idaho. So, only exception.
So other than Idaho, that's why you guys will see that I just tag Weiming on everything related to 1031 in our group, because you can help us all in everywhere. So you said you did 2,000 exchanges. What are some of the biggest fuck ups you've seen people make? Tell me.
I don't even know if you're gonna include what we talked about before the actual presentation. Maybe you will, maybe you won't, but I'll repeat it. It's just letting people know about 1031 exchanges. I had a referral from this real estate agent years ago, and she helped the client do a 1031 exchange, and she was on top of it. It was a very smooth transaction. Unfortunately, I think she forgot to tell her dad about his transaction being able to do an exchange, and dad called me like 3 days late and just um and just wasn't able to do an exchange. So the moral of the story is, get your exchange set up before the close of escrow. We don't charge anything to get the exchange set up. We only take our fees once escrow closes. So there's no cancellation fee if you cancel before close. Um, and don't be worried about us setting up the exchange that way. Gives us more time to review everything and to kind of give you more information about the exchange. So that's one of the big ones because that resulted in a six-figure tax bill. And telling your dad, oops, probably wouldn't cut in.
And well, how early do you want to set up this account though? So would I be starting like say I haven't even begin selling my property, or do you want me to wait until I'm in contract to sell and then come talk to you?
So we can only get that set up once you are in contract. So there's nothing similar to like a pre-escrow, if you will. Um, we're only able to draft the exchange documents once you are in contract, and we can get a copy of the title report. But before then, all we're doing is exploring your options and giving you all the information you need.
Cool. So yeah, and then for people who are considering to do your first 1031s, like I'll be honest, like the money and the stuff is great, but I also want you guys to be mentally prepared that it's not easy and it can be really stressful to identify your three properties or the 200% rule within 45 days. And I'll give you guys an example of what happened to me. And I thought I was doing really great, and then it just went all downhill. So a couple of years ago, I sold a property and I had enough money to buy two quads. And I had to use the 200% rule because like, okay, oh, actually I could only choose three plus the 200% rule. It was the same thing for me because like it would have gone over the amount after I picked them all. It would have gone over the 200 rule. And so I wanted to purchase two out of the three. And I was working with the wholesalers. These are off market deals. They said they'll give it to me. And so I was like, all right, perfect. So I ended up trying to get in contract for those three for like the longest time. And then literally less than 48 hours before I end of my 45 day, the guy backs out. Like two of my properties, they backed out on me. They were like, I need more time to decide. I'm not ready to move out and this and that. I'm like, you were supposed to give me the contract 40 days ago. That's why I picked you guys. And we already discussed the pricing. And so I had about less than 40 something hours to find complete new replacements on the things. Um, and that was really really stressful, not only for me but for my agents. I was working with at least more than one city, so I was trying to figure out like, okay, you help me get some, you help me get some. But in the end I ended up only being able to buy one out of the three. And then I was like, this was like something's just, it freaks you out. And it's not foreign property, it was out of state properties. Oh, but maybe y'all was probably asking though, if you can 1031 into a foreign properties.
Oh, okay. Foreign properties for foreign properties. Yes. US for US only, and US territories as well, but they come with additional requirements. The one that I like to use as an example, Guam. If you want to exchange into Guam, you need to have business interest in Guam. Yeah. So that means something that's already generating you some sort of income and a reason for you to get to exchange into Guam. Most people don't exchange into US territories like that. I know Hong Kong to Hong Kong can be done, London to London, Australia to Australia. Um, the complicated thing about it is, number one, it has to have a tax treaty with the United States, and number two is the currency conversion. So, for example, Hong Kong dollar come in today, 60 days later, whatever it is, if it goes out, the conversion rate might not be the same. If you ended up with more money, now you got to spend it, right? If you ended up with less money, now you got to come up with money. So not always fun with the foreign exchanges. So we're going to be a little more picky about doing foreign exchanges.
That's good. So I'm going to make it even one level higher and start mixing in a lot of the different strategies and things that we learned from SARE. 1031 is a really, really great way for us to save on the boot. But what are other things that we've learned about that I can combine strategies to make even more money and like skyrocket my earnings in my portfolio? At least because you
Oh,
have so many investors. So what strategies do you know them using?
oh man. Okay, so you're kind of putting me on the spot. I gotta think about that a little bit. Might maybe come back to me in a little bit after another question or two, because
That's
uh
biggie.
yeah, I
And
mean,
you mentioned the word before, something related to depreciation.
oh, depreciation. So, here's a unique thing about DST is, just to make it short, you can get more depreciation from DSTs. I'll give you an example. Let's say Annie has that $1 million, right? $1 million cash. Let's just say $1 million cash. You put it into a DST with 50% loan to value. As an example, you will get $2 million worth of real estate. A million is your original cash, and a million of debt is assigned to you because the debt is on the real estate. So on paper, you now own $2 million worth of real estate, right? So that additional $1 million on paper is depreciable. So that covers more of your income. So if you have high value properties, this is one of the ways to get even more depreciation, even more write-offs, right? I have worked with clients who have sold um, over $60 million worth of real estate, and in putting into a DST with high leverage like that, they bought over $200 million worth of real estate. The additional over 140 million, that's depreciable, right? Because what was left over of the 60 million, okay, whatever. Whatever is remaining. Could be another 20 million left, another 30 million. But the additional 140 million, they can what that's gonna do for their income, that's a lot. So that's one of the ways that people utilize DST in order to do so. Um, of course, everybody's got their investment strategies and where they want to go. And one of the questions I do get asked a lot is, Weiming, where should I buy and what should I be buying? No, not my area. But if you want to be more aggressive, then the highest return is typically you're going out to buy the property, yourself and hiring a property manager or even managing it yourself. You don't want to pay for a property manager. That's going to get you whatever they charge, right? And in the middle of the road, I see a lot of syndication, a lot of like triple net properties where, yes, they do kind of have to do the research and find the tenants and rent that out and stuff like that. But there's not a lot of management on their part. And last but not least, obviously being the DST, which is completely hands off real estate ownership. Now, the way I've listed it, however, from you owning the real estate yourself and managing all that, all the way to DST, is sort of most return, most work. Um, Sort of, if you're looking at 4 or 5% or so as the DST's return, but no management, no work that needs to be done. So depending on your lifestyle too, I guess.
And then I also have a couple strategies that I want to share with people, and that's what I'm also doing myself too. So one thing that I really max out on is about that depreciation is I do something called the cost segregated studies. And what that means is that normally property, they'll depreciate over 27 years, or if it's like a commercial, I think it's 39 years. And so if you run a cost aggregated studies, what you can do is that you can find out in which parts of your property can be depreciated in a shorter time. So you can mark it off in 5 years. There's the 15 years, and then the rest of the 27. But we're able to push a lot in the front, and most of our depreciation will happen within the first 5 years. So the reason why I do that is because if I have an income earning property, and I have multiple, if I do the COSEG on one, I'm going to rack up like hundreds of $1,000s of depreciation. And what will happen is that it shows up as a negative, like, oh shit, I didn't make money. I'm like, it's phantom negative, right? But I can offset it into a couple other properties that I own. So essentially, I am not paying taxes for several years on the earnings. So that's really huge. But the thing is that your depreciation will run out in around that 5, 6 year mark. It's not going to be completely gone, but you're going to be running low on your bank. And then if I do end up selling that property out the cold, I'm stuck paying the depreciation recapture, and that's a shitload of money. And so what I would do in this situation is I would do a 1031 exchange, buy a new property, and that already gets rid of my depreciation part. I don't have to worry about that issue, and I got a new property out of it. And then what I can do is I do another accelerated depreciation or the cost seg study on that new property, and there we go. I get to rinse and repeat, and I get to play this game again where I don't have to keep paying taxes anymore.
Not fully, but
Not fully, but like a
covers a lot.
significant chunk.
Covers a lot.
It covers a lot.
Yeah.
You probably have to do a little bit more in order to like really cover it, but that just by doing the cost seg studies every couple of years and replenishing it does help you with saving a lot of money just from that sale and kind of the ongoing taxes part. So I would say that's something that I do. And the other one I really like that you had mentioned was that if you're trying to avoid the boot part, just throw the money into the loan and into the property, and then when you're done, cash out refi.
Yeah. So that's something that a lot of people think that, hey, I don't want to throw all my money into the next property. But the way you want to also look at it is, hey, if I pay let's say 100 grand in taxes today, all right, so that's 100 grand. But if I take a loan for 300K, because I'm assuming 1/3 of the 300 is 100 grand taxes, right? I can take a loan out for 300 grand. How, the question becomes, how long do you need that loan for, right? If you don't need it for that long, just a couple years, once you pay that back, it's probably cheaper than the 100 grand that you got to pay in taxes. But if you need that loan for like 30 years or something like that, you're probably cheaper to pay the 100 grand now than to take a $300,000 loan for the next 30 years, right? So that's also some a way you would want to look at it too.
And I forgot a question at first. I forgot to ask you. At first you mentioned something about the timing that there's no limitation unless it's a short-term rental.
Yes.
What is the
So
thing?
yes. So for a 1031 exchange in the tax code, it doesn't require you and doesn't say that, hey, you need to rent it out for a year, you need to rent it out for 2 years. However, for vacation rentals, you have to rent it out for a minimum of 14 days per 12 months for the first 24 or for 24, excuse me, for 24 months. So that means you got to rent it out for 28 days for vacation rentals for that 2 year period. Um, and the unique thing about the vacation rental is you can also use it for 14 days per 12 months for the first 24 months, or 10% of the number of days you rent it out, whichever one's more. So for those who want to buy in Reno, Hawaii, Vegas, places like that, even San Francisco, well, actually San Francisco is a little trickier because there's the certain vacancy laws and stuff like that now. But vacation rentals, you can use it yourself too. You don't have to rent it out 100%, right? Annie needs a place in Hawaii. Yeah, go for it, right?
You're
Do
saying it's a
Air,
maximum of only 14 days. or 10?
No, minimum. You need to
Oh,
rent it out for
minimum.
minimum. Yeah, yeah.
No, I mean isn't the maximum number of days that I can stay is 14 days?
Or 10% of the number of days you rent it out, whichever one's more. So if you rent it out for 200 days, you can use it for 20 days. How the IRS checks? No clue. Um, I mean, I guess they can track your cell phone. Who knows? But um,
It'll be
yeah,
up to
if
you
you
to prove it. That's the thing.
well for them to prove it, right?
No,
If
I mean,
they,
and for us as the taxpayer, I could maybe the government can blame this on you. Like it's your job to figure out to prove that you did things correctly.
well,
Well,
actually, if they audit you, wouldn't they have to prove that you've been using it for longer than you're supposed to?
no, the
Because
question
you're
is, can you prove that you've used it for within the limit and then turn it on to you?
well, or if they're accusing you, if they're auditing you, I think it's up to them to try and prove it, right? You're just like, all right, prove it to me then, right?
So turn the table back on to them.
Yeah. Well, I don't think it's your because they're auditing your records, right? Yeah. So they're checking on you. So yeah.
So next question is from Long. Wants to know, is it common to 1031 into a burr
Uh, Burr.
by
Could you elab
rehab, refinance, rent out, repeat?
buy?
By
Oh,
rehab. So that's still the construction one. It sounds like
well, it's buy, rehab, uh,
refinance.
ref refinance.
Oh, sorry. You rent out, then refinance, and then repeat.
Yeah, yeah, you can do that because you're renting it out. Yeah. So a 1031 exchange doesn't allow for flips and developments. But you can as long as you're renting it out, yeah, it'll qualify for an exchange.
Yeah.
Yeah.
So
Sorry, I didn't know what the what was that something learned in the SEER or is that like
burr
a
burr is a really common phrase like that's been used like from the bigger pockets. So it's kind of
oh,
just for short for
oh okay, okay.
you never heard of this phrase? How can you have been in real estate for so long and not know burr?
I don't know, but
Oh, you need to hang out with us a little bit more.
oh, probably.
See, it says as long as you used all the proceeds from the relinquished property. So long can you explain what's your second part? That I'm not sure I understand you. This is it
So
common to 1031? This is as long as you use all the proceeds from the relinquished property.
yeah, feel free to unmute yourself if you like.
Oh, someone shy.
No, yeah, here we go. Can you hear me?
Yep, we can.
Yeah, there we go.
Yeah. No, just my question is because you have to use all of your proceeds, your whatever you gain from your property that you sold, right? But then you can just dump as long as you dump all of that into your burr, you should be fine, right?
And purchase equal greater to your net. Yeah, so you have to spend all the cash and purchase equal greater to the net.
But all that cash can be for the property plus improvements.
Plus improvements, yeah, if you're doing a construction exchange.
Yeah. Okay. Thank you.
Sure.
All right. Any other more major red flags or fuck ups that you've seen?
Um. The big one of the biggest one is I would say don't tell me one thing and then be completely opposite of that. Yeah, I get because one of the main questions I ask clients is, hey, how long you been renting it for? They were like, oh yeah, I've been renting it 10 years, 20 years. And then like at the last minute they go, I've been renting it, but I never reported rent. Does it count? No, it doesn't count. I mean, like when you rent it to your family and friends and things like that, that's cool, right? That's okay. You can do that if you want to. But if you don't report rental income on your property, it's not considered a rental. All right. So I see Annie go, oh
Oh,
no.
it sounds like those Asian families who take the money and like, I'm just gonna put it in my mattress. Don't report it to the government. And then
Oh,
like, hey, I'm
well,
gonna send
I
you
it
too.
doesn't for me. It's none of
Oh,
my business. But I do have to tell clients that like, hey, you can call it whatever you want, right? You can call property whatever you want, but if it doesn't reflect that on your tax returns, that's a different story. Yeah, and the government was like, "Hey, why are you doing an exchange when you've never rented it out?" Like, "Oh, I have." What are you gonna tell them? Like, I just never reported to you.
also, I don't remember being asked that when I was doing my 1031. Like they don't even ask me for my taxes. Then how in your situation, like how would that have been cut?
Uh, well, it's typically not. So what we do is when we qualify the 1031 exchange, we ask them questions um, that allows us to tell them to say, hey, you've been renting out for 15 years. Um, if you have done so, it will qualify for an exchange. But for me, I phrase it in a way. I ask clients, say, hey, Annie, how long have you been renting it out for? 5 years? Great. As long as you've been renting out for 5 years and you report it on your tax returns, your property will qualify for a 1031 exchange. So that's the way I phrase it, right? And so that's how I've been able to catch a whole bunch of people saying, "Oh, wait, 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 I've never reported." Well, unfortunately, it doesn't count until you do. It's just a lot of times people will ask the questions and say, "Hey, how long you been renting out?" And that's it, right? We're only able to assist you as much as um, as accurate as the information that you can provide us, right? It's just like a CPA. A CPA will help you to report whatever you tell them, but if it's a lie, then they don't know that. They'll still report it whatever you tell
Sure.
them. Yeah.
And then, what are some tips or important things you feel that first timers should know about working with a QI for a
Got
company?
it. So in working with a QI, one of the most important things for clients is ask the QI how they hold your funds, right? And I say this is extremely, extremely important. For us, we only choose banks, for example, like Chase, who would be able to handle these types of transactions, and that would be able to have segregated accounts for the clients. Segregated accounts, not mix them together. We never want to mix all the clients' funds together in one single account. There are exchange companies out there, especially mom and pops, who may want to do that. It's a lot less work and a lot cheaper. But again, don't ever want to do that, right? So while it does take us a little more time because we have to have the bank set up every one of the accounts, and then we have our clients fill out the W-9 form, so we can provide that to the bank, and the bank would tie it to their social security number to identify those accounts. But it's the added security, right? Don't be like impatient or mad about the extra steps we have to do, but we just want your funds to be safe.
And then, speaking of funds, one important thing is that as the seller, as the person that I'm doing the 1031, I am not allowed to touch that money. So have you seen people screw up that way? Like, oh, here's a deposit, and they took it, and uh-oh.
Yeah. So the term is constructive receipt. If you are in constructive receipt of the money, doesn't matter if it's still in the escrow account, or if it's in your bank account, you never used it. Constructive receipt is constructive receipt. You have control of the funds, and you will be subject to taxes. And one of the things that happens is clients say, "Hey, I closed like 2 days ago. The money's still at escrow. Can I do an exchange?" Well, no. Number one, you've already closed escrow. They were like, "Oh, no, no, but I never touched the money." While you have control of the funds, you're able to dictate from where the money goes, how it's used, things like that. So when a client, and one of the differences, when the client needs money on a wire for replacement property, like yourself, you would let your real estate agent or escrow know. They will give us the wiring instructions, right? And we just need your approval. We'll call you. We'll get approval. Say, hey, are we okay to wire the funds? Great, we'll wire the funds. Yeah. So you're never directly telling us, wait, me, 100 grand there, 50 grand in my pocket, 30 grand that way. No, none of that.
So let's break it also down into like a timeline of what happens. Because I think for me is when I was doing it, I was like, oh, I couldn't really like feel it and remember it until I actually really do the timeline. So for those who are doing it for the first time, is that first I have to get in contract, and then I contact Weiming, right? And then
Yeah.
Weiming, you're gonna set up an escrow. And then what happens after that?
Ooh. So once you talk to your advisors, say, oh yeah, okay, you need to do a 1031 exchange, or Tony told you to do an exchange. You contact me and say, hey, we're gonna do this exchange. Let's gonna go run some numbers and see what my exchange is gonna look like, so that I can be sure it's still good for me. Just because you have taxes to pay doesn't mean that an exchange is still the right fit for you,
What
right?
is not a right fit actually?
So sometimes I have a client that says, "Hey, Wei Ming, I know I have taxes to pay, and let's say the $1 million, for example, but I only want to buy a $300,000 property. That's it, right? I'll keep the rest of the money." So in that case, I'll tell you, you're gonna end up paying all your taxes. So no need to do an exchange, right? Well, why go through the hassle, pay the fees, and go through all the work just to find out you end up paying all your taxes anyways? Tell you from the get-go, you're going to end up paying your taxes. No need for an exchange, right? So those are some of the reasons. And I get that a lot, right? Clients would say, hey, I want to keep the majority of money and only put a little bit. Because remember, when you buy the replacement property, it's basis first before you start spending your profit. So when you only put in a little bit of money, that's all your basis. You're keeping all your profit, so you're going to get taxed on all your profit.
Mhm.
So in this case, you list your property, you get into contract, and give us escrow's contact information. Right? We will coordinate with them, get a copy of the contract, the title report, and set up your exchange. And this list on our website, you can check it if you want, or you can print it out, whatever you like. So we'll set up the exchange. We'll get the documents to you. You sign it. You close escrow, and the funds will go into your exchange account. Now, here's your timeline: 45 days to identify, total of 180 days to close. Your replacement property, once you get into contract on one, you're going to need wires and money. You let escrow know, because escrow are the ones who are giving us the wiring instructions. You're not telling us directly to send money here, send money there. Escrow will give us that instruction. All right. And we will wire to escrow for the earnest money deposit, or for the full amount, whatever you want, right? Because you can dictate how much is going to go for the deposits and for the full amount, or how much to that property too. But we are wiring to escrow.
Yep. In
So
my experience, I remember it was a giant email chain between my QI plus my lender and then also the escrow company. And I remember some of the documents that I had to send out was like, hey, show me proof you actually sold your property, or show me that you've actually paid for this and X and Y and Z. So I just remember it was like a giant email chain going on.
yeah, so we prefer to CC the client onto the email, so they know exactly what's going on. I know it could be a lot of emails, but um, at least you're kept up to date, kept in the loop, right? I don't want the client to be in the dark and go, hey, can you do this and that, and just for me to say, oh, we already did that, all right? So that's how we keep the client in the loop. So sorry if there's a lot of emails, but we primarily will be coordinating with escrow for that, getting you the second set of documents. You sign it, you close escrow, your exchange is done. That's it. Now, here's the one of the differences though, is a lot of times exchange companies, when they're done with you, they're sort of done with you, right? For us, we're gonna send you all the information that you're gonna need to take to Tony for tax reporting. We're gonna tell you what forms you need. We're gonna send you those links. All right. I don't want to keep anybody in the dark because there are times where there was one time that this is a big f up. In Annie's words, I had a client who did an exchange and then reported. There was some miscommunication between her and her CPA, and she thought the CPA reported it, and for whatever reason, it never was. So transaction, the sale of the property wasn't reported on her tax returns, and she didn't file this form, even though we sent her this because she just forwarded it to the CPA, and guess it got lost in the sea of emails or something like that. And like 2 years later, she calls me back and say, "Hey, I have a problem. Do you know a good attorney?" And she was asking about stuff like that. And I've found out that not only did she have to pay her capital gains taxes, but there was interest in the few years, over 2 years since, right? That she had to pay interest on, and interest was high. The interest is very close to the rate she was getting taxed for capital gains. So what wasn't pretty. But this is one of the ways we ensure that we get good feedback, that our clients are happy about the transaction. All right, from start to finish. We'll even contact Tony if you're using Tony and say, hey, here's the client stuff for their tax reporting.
See, that's why it's like everyone within Sarah knows like each other and like, hey, yes, I use Tony, the CPA guy. Oh, and then can you go back to the slide where there's the different 1031 options? Because I remember when I was going through them, like the pricing was really like different, and that's why I ended up going with one over say like the late exchange, because like even though it sounded easier. Can you tell us what does pricing look like to do 1031 exchanges?
Sure, no problem. So for the first two types of exchange, it's fairly simple. It's a flat fee, $1,250 that covers the sale of one property and the purchase of up to three. Any additional properties beyond the three purchase, $200. You want to add an additional sale to combine the money, additional 200. So those are flat fee plus, additional. Now the reverse and reverse construction, you're looking at $8,500. So it's quite a bit difference. The big major thing is, let's take a reverse exchange, for example. And the way it's done is we create an LLC, Annie pays for the property, and we will put that property into the LLC and hold it for Annie. Now, the trouble with the reverse exchange is, the bank's going to say, Annie, I don't want to loan you money if Weiming's the one on title to this temporarily. So that's one of the big issues with a reverse exchange. So maybe look through SEER and see who does private money lending, bridge lending. They will do these types of exchanges. So once Annie sells her old property, we will deed the new one to Annie. So that whole process, well, insurance and everything, like we're entitled to this property, right? We're holding an LLC. If anything happens, who does the person sue? Us. Not fun. And of course, the US has to pass the Transparency Act of 2024, the Corporate Transparency Act of 2024. So that means reporting sucks. Because we were temporarily owner of this LLC, right? We got to report that. And when we transfer this to Annie, she's got to report that. So a lot more reporting, not as fun.
So not only the reporting and the exchange costs more money, you had mentioned that one is that you're unlikely to get a loan because the property is not in your name. And that means you're gonna have to have enough money to buy your replacement property before doing all of this. So it's like it just doesn't make sense to do for most people, unless you're like
For a lot of people, absolutely. And it's the same way with a construction exchange too. So we're also holding onto that property while you're making those improvements to it, right? So number one, uh, there's that high cost of the exchange, but when we transfer and deed it back to you, there's that transfer tax you got to pay. So there's that second transfer tax. And at the end of the day, if you're including just exchange fee, let's say there's no loan fees involved, exchange fees plus the transfer tax, you're probably in it for about 9 grand, right? If your tax bill isn't going to be 9 grand or so, probably not worth it. Now, if you include a part money lender, a bridge lender, a private money lender, they might charge you what, between 10 to 20 grand to do that whole loan situation. So combining with the exchange fees and the transfer tax, you might be in it for like 25 grand, 25, 30 grand at the end of the day. So unless, look, if your tax bill is not even that high, not even worth it, already out of the question, right? If your tax bill is that high, let's say your tax bill is 50,000, why are you paying 30 grand just to save 50, right? I mean, like number wise, yeah, it does make sense, but that's a huge chunk. That's like 60% right there. So that's one of the things I walk the client through, right? We want to explore all your options and see what's a right fit for you. Because a lot of clients they think, oh, I absolutely need the reverse. And then they get into it and go, like, oh shoot, I actually don't need it, right? It's too much for me. I don't want to deal with that. It's too expensive. And they may have already started the process and made the offer already before they come to me, right? So just be careful about that.
Mhm. All right, so last question of the night, because I got you for 2 hours.
Oh
So now,
wow, really?
I know I told you I have a lot of questions, and especially I'm thinking about my own, that's why. But Nya wants to know, could we use exchange funds to build an ADU on a current rental that they have?
With the lease back, yes. It's a little, like I said, it's a little complicated. Um, yeah, if you want to be paying like 15 grand or something like that just to be able to build on, yes, there is a way. There's a way, there's a will, right? Is it will way?
If
The
there's a
one,
will, there's a way.
yeah. So yeah, it can be done, but let me tell you, in the years I've been doing this, I've seen one person attempt it. Yeah, it's not easy to do, and a lot of people don't understand the structure. So, um, yeah, most people just don't attempt something like that.
Yeah, it's probably safer that you just if you currently have a rental, what you should do is do a cash out refinance or a HELOC, and then use the funds and build your ADU. Then you can do another cash out refi or something, or then when you have your rental plus ADU, then all in one go do your 1031. You should. I don't think you should be doing it this way because it's too complicated and costly. Keep it simple, folks, right? Awesome. So those are all the questions that we have for tonight. I will be uploading this onto YouTube and I'll share this with everyone later on. I'll post it back up. But if you guys have questions, go ahead and email or text Weiming. He's really fast to respond to and he'll be really helpful. He's helped out myself. He's helped out a lot of our Sarah members, including Nelson's family. So he is someone that we definitely trust. And we will have more of these type of webinars throughout the next couple of weeks so that we can kind of just teach people, a little bit more techniques about how to invest in real estate and save money on taxes, because why work harder? Just work smarter. So thank you guys, everyone, for sticking around for the last 2 hours. We really appreciate it. I talk to you guys soon.
All right,
Bye
thank you.
bye.